Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special housing report brought to you in association with BNZ. Today we've gotten figures showing that house prices are falling according to Quotable Value's July survey. So I thought it was worth looking at what might happen to prices over the next couple of years. Now in the past, I've said that house prices will fall 15% from the peak in late 2007 over the next 2 to 3 years. And I'm sticking to that forecast, particularly after these weak figures today. I've got 10 reasons why I think house prices will fall another 10%. Remember, they're down about 5% already. Now, this is my own personal view, and I welcome your thoughts in the comments below this video. Firstly, the cheap foreign credit that we relied on from 2003 to 2007 has effectively dried up in the wake of the global financial crisis. Before the crisis, our banks were able to go into the hot money markets and borrow that money about 10 to 15 basis points above the basic cost of funds. That cost is now more like 100 to 150 basis points above the normal costs of funds. What does that mean? Well, interest rates are about 1 to 1.5 percentage points higher than they would otherwise be. And the banks are finding it hard to get big chunks of money in from these hot money markets to lend out to us cheaply. So we're not seeing the very low fixed rates that we might have seen in the past. Secondly, New Zealand housing is pretty unaffordable, particularly in the big cities of Auckland, Wellington, Christchurch, and in some of the hotter cities such as Tauranga and Hamilton and Queenstown. When you look at the Roost Home Loan Affordability reports that we put out, it shows that it still costs over 60% of the median take-home pay to service a mortgage, 80% mortgage on a median house. And when you look at the house price to income multiples, they're still well over 7 or 8, particularly in some of the more expensive markets. That compares with 4 to 5 before the market boomed. Thirdly, New Zealanders have started migrating to Australia again. We certainly saw through 2008, when New Zealanders were migrating to Australia, that house prices were under pressure and they fell. They actually rebounded through 2009 as some of that migration slowed to Australia. But it's back on again, and you can see that in the figures. Fourthly, the property tax changes announced in the budget were initially seen as relatively soft, but it's clear they're having a real impact on demand from rental property investors. Rodney Dickens reckons that the impact could be the same as a 100 to 150 basis point increase in the official cash rate. Fifth, deleveraging globally is going to be something that drags down on asset prices and particularly property prices in the developed world over the next couple of years. You can see here from this chart that property prices, and in particular asset prices, were boosted by debt through the last decade or so. And that debt, particularly in the US, got to very high levels, much higher than it was before the 1929 depression. Sixthly, debt saturation. New Zealand's debt, particularly household debt, has hit saturation point at about 160% of disposable income. And you can see here that it topped out in the last quarter of 2008. Since then, it's been falling slightly as New Zealanders repay their debt and choose not to take on more debt. That means we're not seeing the boost to property prices from easy credit that we've seen in the past. Number 8 on my list of the 10 reasons why house prices might fall another 10% are that rents are relatively flat. When you look here at the median rent for New Zealand from the Department of Building and Housing up until the end of June, you can see that it's flat at $300 a week and has been since the end of 2007, early 2008. Now it's up in some areas, particularly Auckland, and in some types of property, particularly 3 to 4 bedroom houses. But across the board, it's been flat in New Zealand, and that means, in real terms, rents have fallen. And in fact, when you look at rents, they tend to track reasonably closely in line with what's happening with incomes. So the talk that landlords will be able to increase rents to compensate them for the reduction of tax breaks and to try and push up yields, I just don't think is credible. Rents tend to move with wages, not with the demands of landlords. Number 9, the banks face even more funding pressure over the next couple of years. There's about $2 trillion worth of loans that will roll over in the US and in Europe over the next couple of years, banks that have to refund their lending. That's going to put pressure up on interest rates globally. And finally, baby boomers are due to retire in the next 10 to 20 years. And a recent piece of research from the Bank for International Settlements shows that real house prices in New Zealand could fall between 30 and 40% over the next 40 years as those baby boomers look to sell those assets back to a reasonably small group of young people. I'm Bernard Hickey. Those were my 10 reasons why house prices are likely to fall another 10% in the next couple of years in New Zealand. I'm Bernard Hickey for interest.co.nz. They were my personal views, brought to you in association with BNZ.